Good day. Welcome to the session. This is the week 5 session, and we're going to be looking at the accounting equation and double entry system. Learning outcomes for this lesson, using the following outcomes as a personal checklist to assess your readiness for future assessments. After the end of this session, you should be able to analyze transactions under the accounting equation. You should be able to define assets, non-current assets, and current assets. You should be able to define liabilities, non-current and current liabilities. Explain what is meant by a proprietary account. Define income and expenses. Discuss the profit motive and demonstrate how gross profit and net profit are derived at. And explain and apply the rules of double entry. So those are the outcomes of this session. Okay, let's just recap then on the rules of double entry accounting. Remember, for every debit, there must be a credit. For every credit, there must be a debit. Okay, let's recap then the assets. Okay, the type of assets account you have your current assets and non-current assets. Non-current assets are assets with a lifespan of longer than 1 year, and current assets are assets with a lifespan of less than 1 year. Examples of non-current assets would be your property, plant, and equipment, your long-term investments, your vehicles, computer equipment. Those are all non-current assets. Current assets will be your cash in your bank, your debtors, that's people, or accounts receivable, that's people that owe money to the business, and your inventory or stock. So those are assets. Now, when an asset is debited, it means the value of the asset increases. So for example, let's say you have vehicles of R1 million. So now you're going to buy another vehicle of 100,000 Rand. So you're going to debit your assets with 100,000, and the new balance will be 1,100,000. So if it debits, it increases. If we credit it, it decreases. Okay, if we take our bank, if we pay money out of our bank, we credit the bank, so money flows out, so the value of the asset decreases. Okay. Let's look at liabilities. Those are amounts that we owe. Now you've got your current liabilities. Those are liabilities with a lifespan of less than 1 year. That will normally be your creditors. That's people, your suppliers or accounts payable, people that you buy from, your suppliers. Okay. The non-current liabilities would be any long-term bond or loans that you may have. Those are the typical examples. In this case, it works opposite to the assets. When we debit the liability, it reduces the liability. And if we credit the liability, it increases the liability. So for example, let's say you pay one of your suppliers. You're going to go to your asset account, your bank. So you're going to credit your bank. So the bank reduces. If you credit the asset, you must now debit the liability. Then we're going to debit the liability account. And the amount that you left owing to your creditors will reduce. When you borrow money on the other hand, on a bond, long-term loan, you're going to credit the liability. You're going to credit the liability, and that means it increases. Okay, income. When you credit the income, it means money that you receive, revenue, and income then increases. So for example, if you then, let's say you've had a sale and you got money, a cash sale, so you're going to credit your income and you're going to debit your asset. Okay. So your income will increase and your assets will increase. Okay, if you debit your income, it means it decreases. This would typically be when you had a sale, but the purchaser returns it. Okay, expenses. There, if we debit our expense, okay, what are expenses? That's your day-to-day expenses to keep your business going and to buy stock, pay wages, etc. Now, when we debit an expense, we increase the amount of the expense. So let's assume I'm paying wages. So I will credit my bank. I'm paying wages. And I'm going to debit my expense account. Okay, if we credit the expense account, it means we reduce the expense. So this is where you purchase stock, for example. When you purchase the stock, you debited expenses, and now you return the stock, so you will credit the expense, and that reduces the expense. Okay, capital, that is the money that the owners put into the business. Again, let's assume a shareholder puts 100 Rand into the business. We know that if it comes into your bank, you're going to debit your bank. So that means we've got to credit our capital account. So we're going to be doing this. So we are going to increase. We credit the capital there, but that means the capital increases. If the owners take money out of the business as drawings, then we're going to debit the capital account, and that's going to reduce. Sorry, the drawings is next door. The capital, if we debit it, means we reduce it. Drawings is the money that they take out of the business. Okay. So in drawings, if they take money out of the business, so let's take the bank example again. They're taking 100 Rand from the bank. So we're going to credit the bank and we're going to debit drawings. So drawings increases. So when you